The average investor loses nearly 2% of their returns every single year. Not from bad stocks, not from a market crash, from themselves. That's not a typo. 2% year after year, quietly bleeding out. Compounded over 30 years, that's the difference between retiring comfortable and running out of money at 75. And here's the part that stings. It's not because people pick the wrong investments. It's because they panic at exactly the wrong moments. They sell when things get scary. They buy when things feel safe, which is precisely backwards. Right now, your money is probably sitting in one of two traps. Either it's all in stocks, because stocks always win long term, or it's sitting in cash, because the market feels too dangerous to touch. Both feel responsible. Both are quietly setting you up to fail. But there's a framework, one that hedge funds and pension managers have used for almost a century, and almost nobody outside of Wall Street ever learns it. It doesn't require predicting the market. It doesn't require being smart. It just requires understanding one idea that most people never get taught. Risk and reward move in cycles, and your money needs to move with them. Stick around, because in the next few minutes, you're going to see exactly why so many smart people go broke, and exactly what to do instead. Let's start with the trap. Most people think investing is about picking winners. Find the right stock. Get in early on the right crypto. But that's not what actually builds wealth. Research from Nobel Prize-winning economist Harry Markowitz, the man who basically invented modern portfolio theory, showed something wild. How you split your money between different types of assets can explain up to 90% of your long-term returns. Not stock picking, not timing the news. Allocation. Here's what ignoring that looks like in real life. Someone puts everything into tech stocks in 2021. Feels like a genius. Then 2022 hits and 40% of their net worth disappears in 9 months. Panic sets in. They sell everything, lock in the loss, and they miss the recovery. Because the recovery always comes, just never on your schedule. Now imagine the opposite person. They keep everything in a savings account because the market terrifies them. Feel safe. But picture hiding $100,000 under your mattress for 10 years. The bills are still there. They didn't disappear. But because of inflation, they now only buy what $70,000 used to buy. Nothing was stolen. It just quietly evaporated. Both people made the exact same mistake. They treated their portfolio like a single decision instead of a living system. Now here's where almost every investor gets fooled, and even professionals fall for this. Everyone's heard, diversify your portfolio. Spread your money around. Sounds smart. But here's the strange part. Most people who think they're diversified are actually making one giant bet without realizing it. Think of your money like a sports team, and each player has a job depending on what season the economy is in. When growth is strong and inflation is low, stocks are your star player. They dominate. That's the 2000s. But when inflation spikes, like the crisis of the 1970s, stocks can go nowhere for a decade, while commodities and real assets quietly outperform. When the economy slows and interest rates crash, bonds become your MVP. That's exactly what happened in 2008. While stocks lost over half their value, long-term government bonds surged. And when everything goes chaotic, like March 2020, cash becomes your safety net, giving you the ammunition to buy, while everyone else is forced to sell in a panic. The mistake almost everyone makes is building a team with only one player. All offense, no defense. That works beautifully when the season favors you. But the season always changes. Ray Dalio, one of the most successful hedge fund managers alive, built his entire firm around this exact idea. Not predicting which season is coming next. Just making sure your team survives all four. Now let's talk about why smart people keep making dumb decisions with money, because this is the part that actually explains everything. Your brain wasn't built for investing. It was built for survival. Thousands of years ago, if something scared you, running kept you alive. That instinct never left. It just found a new target. Your phone screen and your brokerage app. When the market drops, your amygdala, the fear center of your brain, fires exactly like it would if you were being chased by a predator. Your body cannot tell the difference between a bear market and an actual bear. So you do what feels safe. You sell. You check your portfolio 40 times a day. That's not weakness. That's biology, working exactly as designed. It's just working against you. And when markets are climbing, a different trap opens up. It's called recency bias. Your brain assumes whatever just happened will keep happening forever. Stocks climbed for 3 years straight in the lead up to 2000, so surely they'd keep climbing, right? That exact thinking is what pulled millions of people into the dot-com crash, fully invested, right at the top. Here's the twist. The people who build real wealth aren't smarter than everyone else. Warren Buffett has said the game isn't about a high IQ, it's about temperament. They've simply built a system that removes emotion from the equation entirely. They didn't decide in the moment. They decided years earlier, on a calm day, exactly what their allocation should be. And they stuck to it, especially when every instinct screamed to abandon it. So let's make this practical, because knowing this and actually doing it are two very different things. Start with your age, not the headlines. A common starting framework is subtracting your age from 110. That rough number becomes your stock allocation. The rest goes into bonds and safer assets. A 30-year-old might run around 80% stocks, 20% bonds. A 60-year-old might flip closer to 50-50. This isn't a rigid law. It's a starting compass, one you adjust to your own comfort with risk. Then comes the step almost everyone skips. Rebalance once or twice a year. Sell a little of whatever grew too large. Buy a little of whatever shrank. It sounds boring. It is boring. But it quietly forces you to sell high and buy low automatically without ever predicting a single thing. And here's where the gap turns brutal. Two people start with the same amount of money and the same portfolio in the year 2000. One rebalances consistently through the dot-com crash, through 2008, through 2020, ignoring every headline. The other panics in every downturn and gets greedy in every boom, constantly rearranging their money based on fear. Over those 25 years, that discipline gap alone can be worth hundreds of thousands of dollars. Same market. Same starting point, completely different life. The difference was never intelligence. It was whether they had a system or just a feeling. So here's the real takeaway. The market doesn't reward the people who predict the future correctly. It rewards the people who prepared for every version of it. Your portfolio isn't built for the economy you're in right now. It's built for the one you can't see coming yet. The next crash isn't a question of if. It's only a question of when. And when it comes, your future won't depend on whether you guessed it correctly. It'll depend on whether, years before it ever happened, you already built something strong enough to survive it.